We are being joined by Mr. Ashwini Kumar Tewari, Managing Director at SBI. Mr. Tewari, thanks for joining us. Muralidhar Swaminathan here, and my colleague Pallavi is also here with me. My first question to you, sir, is the RBI governor sounded quite hawkish.
Yeah, so tough to comment on whether he sounded hawkish. Otherwise, these are not. We don't generally speak on nuances of his posture or words, etc. We focus more on what he said actually. So in that sense, whatever he said, he basically wanted to tell the market that look, do not seek or do not be very sure about rate cuts immediately. We will continue to monitor, and if the situation so arises, we will take a look. But it's not imminent. That's how I read it.
Right. So he again, he said that look, we are not going to change the stance, which was made very clear. The withdrawal of accommodation continues, but considering the situation, the banking sector, do you think that there is a liquidity problem right now?
So overall system liquidity is surplus, as he explained, for July. But in terms of the bank deposit growth lagging the loan growth, that's something which is well on record. For the last 8 to 9 quarters, this has been the case, that the deposit growth is behind the loan growth percentage wise, but also sometimes absolute wise. So clearly there is a shortfall which is happening, and many of the banks have CD ratios of upwards of 80%. We are of course below 70 at the moment. So therefore, there is a challenge for deposit. Rates of deposits have gone up, as we all know. Even as we say this, the benchmark rates for the system government, that is the 10-year GSEC, and also the 3 billion T-bill, both have fallen sharply in the last 1 or 2 months. So in that sense, the impact on the deposit rates per se is slightly different from what is happening already in the overall benchmark rates. So we clearly have a deposit challenge as we speak, and the governor also acknowledged this and said that instead of relying on, let's say, the non-retail short-term deposits, probably leading to the deposits, the bulk deposits, the bank should focus on the core retail deposits by having innovative products. So that's something we are already focused on, and all of us are trying to do that.
So which means that in addition to the inflation and the data concerns which are coming in the way of a rate cut, in case if and when the rate cut happens, maybe 3 months or 6 months down the line, will it add to the problems of the banking system in terms of raising funds?
So raising funds doesn't necessarily have to be linked to the availability of the rate cut, because what that will do ultimately is reducing the interest rates in the system. So the loan rates, which are largely floating, will immediately reprice, but the deposit rates which are fixed and which will reprice with a lag as and when the deposits mature. So there will be a pressure on the margins in the short term for the banking system when that happens. So cost of deposits and loans will change, not so much the availability of it. The availability will be changed only from 2-3 things. One, of course, the most important is that if the markets were to correct in a major manner, then some of this money which is right now going to market may come back to the banks, because there is a comparative yield which is happening in the markets which the bank deposits are not yielding at the moment. So that would be the real driver. In addition to that, of course, there are other things. For example, the overall segments of the population and segments of our customers which haven't been focused on so much, and we are trying to focus on them now. Those again are areas where perhaps we can get some more deposits, but it's the comparison with markets which the government pointed out is the most important short-term factor.
All right, sir, hi, this is Pallavi joining in as well. So, like you've mentioned, banks, including yours, are already taking measures, trying to be more innovative to attract more deposits. But like you said, we're already seeing a lag that's persisted for the last 8 to 9 quarters. What is the outlook going forward? How do you expect this to play out? And if this gap continues, what are the implications from a banking industry perspective as well as from an economy perspective?
See, the one thing is that the continued loan growth indicates that there is an economic activity which is picking pace, and which is a good thing. And in this, if I can talk about our bank, the agriculture growth rate, loan growth rate has been upwards of 17% for the last year, including the Q1. The SME loan growth has been 20% plus. So these are productive sectors. These are not consumption loan growths. And in the housing loans also, we have had a strong growth of nearly 15%. The system is slightly higher than this. So clearly, these are sectors which are seeing good growth. Even corporate side also, we are seeing good growth. I think we ended the year at 18%, and even Q1 was quite good at 15.5%. So these are the sectors which we normally want growth so that the economy gets supported and economic growth happens. So that's a given that in case these sectors are growing, then we should find a way from the banking system to support these sectors. Now, how do we fund them? One is, of course, deposits continue to be very important, and 90% of loan growth traditionally has been funded by deposits. But since we have a short-term problem which is unrelated to this loan growth, the answer which most banks have taken so far is to raise money separately. For example, many of the banks have raised infrastructure bonds. These allow you to fund straight away without the SLR, CRR, and of course this is long term. And the infra book of many banks and ourselves included is large enough to be able to absorb this kind of instrument. The second thing is the AT1, etc. Again, banks are doing that not only for the capital ratio but also for funding, etc. So I think there are some ways. Some banks have gone in for bulk deposits, which the governor cautioned against. And I guess hopefully this situation will not arise that the loan growth has to be crimped in order to balance out the deposit. That has not happened, but except for a couple of players whose CD ratios are very, very high, nearly 100% or more, they have had some issues where they are now trying to downsell some portfolios, etc. I hope this is not the situation going forward.
All right. So you broadly believe that it is unlikely that we will see credit growth having to be trimmed because of the current situation. Is that right?
That is right. And I just compare this situation to some years back when we had a similar situation. Markets were doing very, very well, and deposit growth was lagging the loan growth for about 4-5 quarters. But ultimately, it evened out as the markets corrected and as the banks also focused more on deposits like we are doing now. So this came back to the normal. So I guess this ultimately will happen. The only caveat I have there is that in all developed markets, the investment, the move from saving to investment is something which is a secular trend. And in our country also, ultimately this is going to happen. But once that happens, the alternate sources of the funding of corporates, let's say the corporate debt market, the bond market, etc., will also develop alongside. So this will ultimately balance out. But for the time being in India, I think this will revert back to the normal mean which we've had, whereby deposits are gathered and they largely fund the loans.
Right. So the question, you have given some great insights. I think you would be able to help us understand the very important question which has been floated by the RBI in their discussion paper going forward. You know, the ratio of deposits that you have to keep has to go up to make sure that liquidity is taken care. What are your thoughts on that?
So first of all, it's a discussion paper, and as the governor also did not comment on in his own commentary with the journalists later. So I wouldn't like to take any stance on this. We have given our feedback to RBI on this. As it stands, yes, if that is implemented as is, then clearly there will be some haircuts to be taken. Runoff factors have been increased, so more of the deposits will have to be given for HQLA. But I think through mutual discussion, we will come to a satisfactory solution. The concern probably was through the Silicon Valley Bank, where a lot of deposits were taken out through the internet and online channels. And since we also have a lot of customers on online and they are increasing, and it's a desirable thing. So I think that was the concern. But since the governor is also on record to say that we will discuss with everybody involved, all stakeholders, and we have given our feedback, I would not like to comment on how this will play out going forward till we have the final guidelines.
All right, sir. One quick question before we can let you go. The RBI governor today also spoke about how economic growth remains resilient, even though inflation has been a point of concern currently and does not look like it's abating immediately. What are your quick takeaways on that front? From your perspective, what's growth looking like broadly, and what is the expectation going forward?
So economic growth is definitely stable, definitely resilient, as the governor also explained. we have had several quarters of 7% plus growth. So I think that's doing well, and we see this in the terms of the growth in our portfolios, as I explained earlier, both SME, the retail, the agriculture, all of them, corporates, all the segments are seeing broad-based, good quality double-digit growth, high double-digit growth. So clearly the economy is moving up. And we also see this in terms of all the other numbers, in terms of sales of various companies, etc. So therefore, the economy is clearly doing well. As far as inflation is concerned, I mean, at 4.8%, it is not as high. Of course, the RBI is on record to say that they would expect a 4% sustainable inflation. But I think 4.8 is not something which is crimping or affecting growth in a big manner. So I don't think that's a real concern at the moment. They, of course, want the inflation to come down largely because the customers get hurt, the retail people get hurt. So in that sense, they're working on that, and economic growth is very stable. It's doing well. We are the largest growing, fastest growing large economy in the world. So I think that speaks for itself.
All right. Thank you so much, Mr. Tewari, for taking time out to speak to NDTV Profit. We hope to have you back with us soon enough.